The US dollar lost nearly 11% of its value since January 2025. That's the biggest annual drop in 8 years, and the dollar just keeps on falling. Now, you might think that currency movements are just abstract numbers on a trading screen that don't affect your daily life. But here's what most people don't realize. When the US dollar weakens, it touches everything, from the price of your morning coffee to the stability of your retirement savings, from the USA's economic growth to whether foreign investors will keep funding US debt. But what happens right now is far more dramatic than a simple market correction. The dollar is experiencing a fundamental reordering driven by forces that could reshape the global economy for the next decade. Political uncertainty, fiscal imbalances, and a complete reversal in monetary policy are converging all at once. And in this video, I'll break down exactly why the dollar is tanking, what it means for the US economy, and most importantly, what it means for you. Whether you're an American watching prices rise or foreign investor holding US assets, this affects you directly. I'm Stephen Nikander Højlund, a Danish social science PhD, reporting for the Danish Stream Media Group. You can read our news in English for free on the danishstream.com website and buy us morning coffee using the link in the description and up here. Let's start with the numbers. The US dollar index fell 9.4% in 2025, the largest decline since 2017. By early 2026, it hit 4-year lows around 100 on the US dollar index. That's the same relative value as in 1973 when the US dollar index started to measure the US dollar against a basket of other currencies. Also, the euro has gained 12% against the dollar from January to November 2025, so the trends are very clear. What is driving this collapse? The primary driver is something called interest rate compression. Here's what that means. For years, the Federal Reserve kept interest rates higher than Europe and Japan. This created a powerful incentive for global investors to park their money in dollar-denominated assets. Why? Because they could earn more returns here because the interest rate was higher. But that advantage has now completely disappeared. The Fed has cut rates 3 times since September 2025 and is signaling 2 to 4 more cuts in 26. Meanwhile, the European Central Bank is holding rates steady, and the Bank of Japan is actually tightening gradually. Let me give you the exact numbers. Eurozone real yields hit 0.9% in early 26, the highest level since 13. US real rates stayed around 2%. But that spread is narrowing really fast. And when the interest rate advantage disappears, so does the reason to hold dollars. Capital then flows out of the US and the dollar weakens. It's as simple as that. But interest rates are only part of the story. The second major factor is what I call the growth narrative inversion. During 2023 and 2024, the dollar was strong because everyone believed the US economy would outperform Europe. American growth was expected to hit 3%. That attracted foreign capital, which pushed the dollar higher. But that story has completely flipped. US growth projections have now moderated to just 1.8% through 2026. At the same time, the Eurozone is experiencing renewed economic momentum. Germany is implementing fiscal spending initiatives, labor markets across Europe are showing resilience, and frankly, the economy also here in Denmark is doing absolutely fine with almost record low unemployment. At the same time, growth in the US seems to be driven largely by big tech and investments in AI. This is all the while the real economy is not looking that great or even actually retracting a little bit. So the growth gap, which once favored the US, has vanished completely. And with it goes another pillar that supported the dollar. Now, here's where things get really concerning. The third driver is political uncertainty. The Trump administration has explicitly signaled it wants a weaker dollar. This is basically market policy. And why would they want that? Well, they wanted to boost export competitiveness and reduce the trade deficit. But here's something more troubling happening beneath the surface. The administration has been pressuring the Federal Reserve, raising questions about its independence. There's speculation about restructuring treasury obligations and even removing Fed governors. On top of that, Donald Trump fired the head of US Bureau of Labor Statistics. This also created some uncertainty around the independence and objectivity of key economic statistics. And more generally, the US political landscape is conflictual and unstable. This can be seen in the ritualistic difficulty the system has to agree on a federal budget. This creates what markets call a political risk premium. That's the extra compensation investors demand for holding assets in a country where the rules might change rapidly. Traditionally, the US has gotten a lot of slack on this, probably because it's such a large market and probably because many market actors are coming from the US itself, so there's a lot of bias in the system. Just think about how markets react to just slight uncertainties from China, for example, where suddenly all stocks are plummeting. Or just take, of course, a smaller country like Italy or even Greece, where the sort of historical anticipation is that you have less stability in that market and in the political world of that country. This creates what markets call a political risk premium. That's the extra compensation investors demand for holding assets in a country where the rules might suddenly change. For decades, foreign investors trusted US institutions. You could even argue that the US has been cut a lot of slack when it comes to trust. Investors believed that the Federal Reserve was independent and that treasury bonds were the safest assets in the world. But that confidence is eroding, and when confidence erodes, capital leaves. Foreign investors are now actively hedging against further dollar weakness. And some are adding new hedges entirely. The foundation of dollar strength, that is institutional credibility, is cracking. The fourth factor explaining the dollar's fall is a huge one, and it's structural. The US is running a massive fiscal deficit. We are talking about deficits up to 7% of GDP over the coming years. That is, the US needs to borrow 7% of its GDP to keep the wheels running. US national debt is projected to hit up to 125% of GDP by 2030. Some sources suggest that we are already at that figure right now. These imbalances require continuous foreign financing. But here's the problem. Foreign appetite to fund US deficits at stable valuations is not guaranteed. Foreign central banks are already diversifying their reserves. They're buying gold instead of treasuries. That's why gold prices are all-time high and just crossed into the $5,000 territory. That's a massive vote of no confidence in the dollar. To put it differently, you are translating from one security asset to another one, hedging against the first one. One federal analyst noted that the Federal Reserve's real effective exchange rate stands at 115 versus a long-term average of 101. That suggests that the dollar is still overvalued even after the recent decline. There's a substantial scope for further depreciation. So those are the four key drivers: interest rate compression, growth reversal, political uncertainty, and fiscal imbalances. But what does all this mean for the US economy? Dollar depreciation creates winners and losers. Let's start with the winners. US exporters are getting a boost. When the euro to dollar rate moved from 0.91 in Q4 24 to 0.83 by mid-25, then that made US goods 9% cheaper for European buyers. American manufacturers in sectors like industrial equipment, medical technology, and digital services are gaining market shares. This is the main benefit of a weaker dollar. It makes American products more competitive globally. But now for the downside, and it's quite significant. Import prices are rising. A 10% depreciation in the dollar adds approximately 30 basis points to core inflation. And here's where it gets worse. And as you know, Trump is wielding around different tariffs for different countries at any given point in time. So it's a bit difficult to know exactly what stands right at the moment. But combine all these tariffs with dollar depreciation and you're looking at a sticky inflation well above the Federal Reserve's 2% target. Core PCE inflation is already running at 2.6%. So what does this mean? It means higher costs for US manufacturers who depend on foreign inputs. It means the Federal Reserve might have to keep interest rates higher for longer, even as economic growth slows. That's the recipe for what economists call stagflation light. Slow growth, high inflation, rising unemployment. Who's the winner in this scenario? Big tech wins due to higher overseas markups while they're not dependent on imports the same way. The big losers, well, it's the ordinary US citizens. Let's look at what it all means on a personal level for the average American. First, US citizens are going to pay more for imported goods. Electronics, automobiles, clothing, anything containing imported components will cost more. The 9.4% depreciation in 2025 is adding about 9 basis points to core inflation, with effects persisting through the second half of 2026. This hits lower-income households much harder. They have limited savings and fewer ways to hedge against inflation. Second, if you're planning to travel internationally, it's just gonna be a lot more expensive. A weaker dollar means each dollar buys fewer euros, yens, or other foreign currencies. Your vacation in Europe, your study abroad, or your business trip all cost more, essentially. Third, the labor market effects are complicated. In theory, export industries like manufacturing and agriculture should hire more workers. But this relocation is slow and painful. On top of that, the foreign demand is also uncertain, given that there might be retaliation on the tariffs that Trump imposed on the rest of the world. Moreover, the rest of the world, now losing a bit of market shares, might support and prop up their local domestic producers. And if the Federal Reserve is forced to keep rates high because of inflation, you could see the job market weaken instead of strengthening because companies cannot borrow as cheaply as they could before and they cannot reinvest and start new investments, leading to more job creation. The first half of 2026 is particularly risky. So for most Americans, dollar weakness means one thing: your purchasing power is shrinking. Now let's talk about foreign investors. This group holds over 30 trillion in US assets and they're facing serious headwinds. First, they're experiencing direct currency losses. Imagine a European investor with 1 million in US stocks. If the dollar weakens 10% against the euro value of their investment declines. But hedging is accelerating, which creates additional selling pressure on the dollar. Second, US treasuries are losing their safe haven appeal. For decades, treasuries were the world's preeminent safe asset. It's liquid, it's stable, and it's credible. But that's changing very rapidly at the moment. The Bank for International Settlements reports that the correlation between US treasury prices and the VIX volatility index has shifted towards zero since April 25. That means treasuries no longer reliably provide portfolio insurance during market turbulence. Political risk premiums are rising. Foreign investors increasingly view the dollar and US assets as contingent on political whims, not rule-based institutions. So capital is diversifying due to higher risk, but it's also going into Asian emerging market currencies or into European assets. And here's the dangerous part. If dollar weaknesses accelerates, it could trigger a self-reinforcing cycle. Capital outflow push treasury yields higher. Higher yields tighten financial conditions. Tighter conditions reduce foreign investment, which cause more dollar weakness. The previous dollar cycle peaked in 2001 and experienced a cumulative 41% decline through 2008. If current conditions resemble that precedent, we could be at the beginning of a multi-year bear market. So, what is the outlook for 2026? Consensus forecasts anticipate continued dollar weakness through mid-2026. Morgan Stanley projects the dollar index will fall to 94 in Q2 2006, a level not reached since 21. They expect a recovery to 100 by year-end, driven by fiscal stimulus and growth stabilization. BNP Paribas forecast Euro-US trading at $1.24 by December 2026. Berthman Bank predicts Euro-US at $1.25. UBS expects a 2 to 3% gain in the dollar index back to 100. But these forecasts carry material tail risks. If political pressure on the Federal Reserve intensifies, forcing deeper rate cuts than fundamentals warrant, inflation could become untethered. Conversely, if foreign investor capital flight accelerates faster than currently priced, long-term treasury yields could spike. That could trigger a funding crisis for highly leveraged entities, forcing the Fed into emergency intervention. The fundamental question is this: is the dollar simply revaluing from an overextended level, or is it entering a multi-year bear market driven by structural loss of confidence? That question remains unsolved. Here's what we know for certain. The US dollar's 10% depreciation since early 25 is not a random market fluctuation. It reflects a rational repricing of currency fundamentals, narrowing interest rate differentials, improved growth prospects outside the United States, rising political uncertainty around US institutions, structural fiscal imbalances. For the US economy, exports gain competitiveness, but consumers face import-driven inflation and reduced purchasing power. For ordinary Americans, we will see higher prices on imported goods and international travel, with particular hardship for lower-income households. For foreign investors, currency losses and erosion of the dollar's safe haven status create compelling reasons to relocate capital away from US assets. Big tech, especially software, seems to be sitting comfortably, taking advantage of higher export returns in dollars and low reliance on imports. But here the risk is around the confidence in AI's ability to create real productivity gains, matching the massive infrastructure investments made to power the AI revolution. Eyes will definitely be on OpenAI's ability to earn money, and on ASML will companies continue to buy machines for the chip manufacturing industry. There is definitely signs of a bubble in the AI space, and if it bursts, this could also have serious consequences on the US economy, starting a global bear market as well. The global financial system has been structured around dollar dominance and stable US institutions for decades. Any erosion of confidence in either can trigger rapid destabilizing adjustments. The coming years will test whether the dollar's decline remains orderly or accelerates into genuine instability. If you found this video valuable, make sure to subscribe so you don't miss future updates on the critical stories out there. And share this video with a friend who might be concerned about their investments or wondering why prices keep rising. This information could save them thousands maybe, or help them make smarter financial decisions. Thanks for watching.